CME Group just raised silver margins by 36%, from 11% to 15%. Not before the crash, not during the crash, but after the crash. They waited until silver had already dropped 31% in a single day, the worst collapse since 1980. And then they pulled the trigger on margin hikes that force even more selling. This isn't risk management, this is a coordinated attack. And I'm going to prove it to you with their own data. Because while retail traders are getting liquidated and panic selling their positions, someone else is quietly covering shorts at the exact bottom. And I have the receipts. Let's go. First, let's understand exactly what happened this weekend while you were sleeping. On Saturday, February 1st, CME Group, that's the Chicago Mercantile Exchange that controls COMEX futures, announced immediate changes to margin requirements across all precious metals. Effective today, Monday, February 2nd. Here are the numbers. COMEX gold futures margins increased from 6% to 8%. That's a 33% increase in the amount of cash you need to hold a position. COMEX silver futures margins increased from 11% to 15%. That's a 36% increase. Platinum went from 12 to 15%. Palladium from 14 to 16%. Now, for those of you who don't trade futures, let me explain what this actually means in real terms. Let's say you're holding a $100,000 silver position with the old 11% margin requirement. You needed $11,000 in your account to maintain that position. Under the new 15% requirement, you now need $15,000. That's $4,000 of additional cash you must deposit immediately. If you don't have it, forced liquidation. Your position gets closed at whatever price the market is trading. And guess what? When thousands of traders are forced to sell at the same time, prices collapse even further. This creates a death spiral. Lower prices trigger more margin calls. More margin calls create more forced selling. More selling drives prices lower. Rinse and repeat. And here's the truly insane part. This is happening right now while silver is still crashing. As I'm recording this, silver is trading around $77 to $85 per ounce. That's down another 14% from Friday's close. So, let me ask you a question. If you're CME Group, and your job is to protect market stability, when do you raise margins? Do you raise them before a historic crash when you see volatility spiking? That would make sense. That's actual risk management. Or do you wait until after the crash has already wiped out $7 trillion and then raise margins when traders are already bleeding, forcing even more liquidation? That's not risk management. That's throwing gasoline on a fire. Let me walk you through the exact timeline of events, because when you see it laid out, the coordination becomes obvious. Monday, January 27th through Thursday, January 30th. Silver is rallying hard. We hit $121 per ounce. Historic highs, retail traders are euphoric. Social media is flooded with silver to $200 predictions. The FOMO is at peak levels. Thursday night, January 30th, right before the close, someone dumps massive contracts. I'm talking about the kind of selling that doesn't care about price, the kind of selling designed to trigger stops and create panic. Friday, January 31st, the massacre. Silver crashes 31.4% in a single session. It falls from the 90s all the way to $78. Gold collapses 13.6%, total market wipeout. $7 trillion erased across precious metals. This is the worst day for silver since March 1980. That's 46 years. Saturday, February 1st, CME Group announces margin increases across the board, effective immediately on Monday. Monday, February 2nd, today, margins go into effect. And what happens? Silver crashes another 14%, gold drops another 5 to 7%, stock markets are bleeding, commodity liquidity crisis, full contagion. Now here's what's suspicious about this timeline. CME has real-time data. They see volatility rising, they monitor open interest, they track price movements tick by tick. If they were genuinely concerned about market risk, they would have raised margins on Wednesday or Thursday when they saw the setup developing. But they didn't. They waited until Friday's bloodbath was complete. Waited until retail traders had already been destroyed. Waited until the maximum amount of fear had been injected into the market. And then they raised margins, guaranteeing that Monday would see forced liquidations from everyone who survived Friday but doesn't have spare cash sitting around. This is a squeeze play, and retail traders are the ones getting squeezed. So if retail is getting crushed, who's on the other side of this trade? Let me show you the commitment of traders data from the CFTC. This report comes out every Friday and shows us exactly who's positioned where in the futures market. In the weeks leading up to this crash, we saw something interesting. Commercial traders, that's the big banks like JP Morgan, Wells Fargo, HSBC, these guys were massively short silver. We're talking concentrated short positions at multi-year highs. Meanwhile, retail traders and small speculators were piled into long positions. Everyone was bullish, everyone thought silver was going to $200. Classic setup. The banks were short at $120. Retail was long at $120, and then the price collapses to $78 in one day. Who wins in that scenario? The banks who were short just made money on a $42 per ounce move. That's massive profits. Who loses? Retail longs who either got stopped out or margin called into oblivion. Now, I want to be clear. I can't prove that CME Group colluded with these banks. But I can show you that the timing of these margin hikes perfectly benefits the entities that were heavily short and desperately needed prices lower to cover those positions profitably. Let me give you another piece of evidence. First notice day for February silver contracts was last week. That's when traders who are long futures can demand physical delivery of silver. 9.4 million ounces of delivery notices were issued. Wells Fargo issued 701 notices. JP Morgan issued 395 and stopped, meaning took delivery of 487 notices. Macquarie issued 459 and stopped 533. These banks are actively involved in the physical silver market. They need to manage their positions. And the best way to do that? Orchestrate a price crash, cover your shorts at the bottom, and let margin hikes force out the weak hands who might demand physical delivery. It's the perfect crime. And it's legal because they control the exchange. But here's where their plan has a fatal flaw. While paper prices on COMEX are collapsing, the physical market is doing something completely different. Shanghai silver prices right now are trading at a significant premium to COMEX. The last time I checked, Shanghai was around $110 to $115 per ounce, while COMEX is at $77 to $85. That's a $25 to $35 premium. That doesn't happen in a normal market. What that tells you is that the physical market, where real silver changes hands, is rejecting COMEX paper pricing. Bullion dealers across the United States and Europe are reporting the same thing. Premiums on physical coins and bars are rising, not falling. Inventories are getting tight. Delivery times are extending. You know what that means? While the paper market is in freefall, actual buyers of physical silver are stepping in aggressively. They're treating this crash as a gift because they understand that fundamentally, nothing has changed. Solar panel demand? Still exploding. Electric vehicle production? Still ramping up. Electronics manufacturing still consuming massive amounts of silver. Industrial demand hasn't disappeared. China's export controls on silver that went into effect January 1st? Still active. That's restricting global supply. The only thing that's changed is that leveraged traders on COMEX got liquidated, that's it. So we have a massive divergence. Paper market says silver is worth $77. Physical market says it's worth $110 to $125 in Shanghai, plus high premiums in the West. This is the same pattern we saw before previous silver squeezes. The paper market gets manipulated down, physical buyers accumulate at suppressed prices, and then eventually, the rubber band snaps and paper prices rocket higher to meet physical demand. The question is, how long can they keep the paper price suppressed this time? So what do we do with this information? If you're trading on margin right now, you need to understand that this environment is a meat grinder. The CME can raise margins again at any time. They did it in 2011 during the last silver run. They raised margins 5 times in 8 days and killed the rally. They can do it again. So if you're going to trade futures, you better have deep pockets and risk management that accounts for sudden margin increases. Don't be over-leveraged. Don't assume anything. If you're a physical silver buyer, this is exactly the scenario you've been waiting for. Paper market manipulation creating disconnect from physical fundamentals. This is when you accumulate, not with margin, not with leverage, with cash, for physical metal. Because here's what I believe is going to happen next. Short term, this week, we could see more volatility. The margin calls are hitting today. Traders who don't have cash will be forced out. That could push prices lower in the very short term. But medium term, next few weeks, I expect a violent rebound. Why? Because the selling is forced, not fundamental. Once the margin call cascade is complete, there's no natural selling pressure left, and physical demand is sitting underneath this market like a coiled spring. Long term, months ahead, the fundamentals haven't changed. We still have supply constraints, we still have exploding industrial demand, we still have geopolitical instability driving safe haven flows. The only question is whether COMEX paper pricing can continue to suppress the real physical market price, and my bet is that it can't, not forever. Eventually, the divergence becomes too extreme and something breaks. Watch Shanghai, watch delivery notices, watch COMEX registered inventories. Those are your signals. If Shanghai premiums keep widening and COMEX inventories keep draining, that tells you physical demand is overwhelming paper manipulation. And when that breaking point comes, the rally will be explosive. Look, I can't tell you this was a coordinated attack with absolute certainty. I'm not inside CME's boardroom, I don't have recorded phone calls between banks. But I can show you the timeline, I can show you the data, I can show you who benefits. And I can tell you that in 20 years of watching these markets, I've seen this movie before. Every single time silver starts to run, something happens to kill the rally. Margin hikes, futures dumps after hours, coordinated selling at key technical levels. It's not a conspiracy theory when you have the data. They don't want you to win this trade. They want you scared. They want you liquidated. They want you out of the market so they can cover their shorts at the bottom and ride the next leg up without you. Don't give them the satisfaction. If you believe in silver fundamentals, this is the gift. This is the shakeout. This is where weak hands panic and strong hands accumulate. Do your own research, verify everything I've said today with the sources in the description, make your own decisions based on your own risk tolerance. But whatever you do, don't let a margin hike and a coordinated paper market dump convince you that the silver thesis is dead. It's not dead. It's on sale. Hit the like button if this analysis helped you see through the manipulation. Subscribe if you want daily breakdowns of what's really happening in these markets. And drop a comment. Did you survive today's margin calls, or did they take you out? I'll see you tomorrow with an update on Shanghai's response to this disaster. Stay sharp, stay liquid, and stay in the game.